In this video, we're going to go over some basic income statement transactions. We're going to record revenues and expenses. But before we do that, let's review our basics of our accounting equation. Our balance sheet is assets equal liabilities plus equity. And then also let's remember something basic about our debits and credits. Debit simply means the left-hand side of a T account. Raise your debit hand right now. Credit will mean, of course, the right-hand side of a T account, and you can raise your right hand or credit hand right now. And recall that we increase assets with debits, and of course, debits then would decrease liabilities and equity. And credits we found were what we would do to record increases in liabilities and equity, but credits decrease assets. So again, debit simply means left-hand side of a T account, and credit means the right-hand side of the T account. Let's go ahead now and take a look at the income statement. Revenues minus expenses equals net income. And the most important things we want to remember about our income statement is we have two basic rules under accrual basis accounting. The first was our revenue recognition principle. Revenues are recognized when we deliver the goods or perform the service, regardless of when payment is received. Think about it. Many businesses, you pay up front before they perform the service. Think about airline travel, gym memberships, subscriptions. You pay today, but you're not going to fly for 3 or 4 months. So the company has a liability. They don't actually have a revenue until you take the flight. For the gym membership that you pay up front, they actually don't have a revenue until they provide the service. In other words, you use your gym membership or it expires over time. The publisher doesn't have a revenue until they send you that magazine subscription. Many transactions, of course, the cash and the revenue happen at the same point in time. Walk into McDonald's and you buy a burger. They have a revenue and you make a payment at the time of service. Go to the gas station, you pump some gas. They have a revenue, they've delivered the goods at the same time you've made the payment. So we can have an exchange of payment at the time of the revenues occurred, but oftentimes the revenue is recorded after the payment has been received. And of course, there's those situations where you don't pay until after the service has been performed. Think about the electric company. You're using electricity right now to run your computer to watch this video, but you won't be billed until later in the month or perhaps next month. PP&L or whoever your provider is earning a revenue right now because they are providing a service. You go to the hospital and they provide a medical treatment. They're earning a revenue, even though they won't bill you until next month. So again, to summarize, we record revenues when we deliver the goods or perform the service. It doesn't matter when payment is received. Our second fundamental rule of accrual basis accounting was the matching principle. As we incur cost to earn revenues, we want to record those at cost as expenses in the period they generate revenues, regardless of when cash is paid. And recall, we had sort of two broad types of cost we could talk about. One were period costs. And period costs, they don't provide any future economic benefit. And so we record them directly as expenses today. Recall, the definition of an asset was something that was going to provide a future economic benefit. The salary we pay to the person working the cash register in our store, that's not going to generate revenues tomorrow or next week or the next month. The utilities we're using to light our store, to run the register, that's not going to generate any revenues next month or down the road. Routine maintenance, the same story. So costs that don't provide a future economic benefit are considered period costs, and we record them as expenses today. On the other hand, recall, we do incur many costs that do provide a future economic benefit. And those costs we capitalize, and capitalize simply means record as an asset, and then we will match them with future revenues. The easiest cost we talked about was inventory. We're buying merchandise today, we're going to sell it to customers next month. We record it as an asset on our books, inventory. When someone comes in and actually buys that inventory, we record a sales revenue as well as a cost of goods sold. If we're paying rent in advance, that rent is going to be used for our space to generate revenues in future periods. So we record it as an asset today, and we will record rent expense over time as that asset expires. Plant, property, equipment, that's fixed assets, that's computers, that's trucks, that's buildings. They all generate future revenues over multiple periods of time. We record those as assets today, and then we will match that cost with future revenues through depreciation expense. And that's going to be a topic of a later chapter. So again, let's take a look at that basic income statement. Revenues minus expenses equals net income. And from our debit and credit perspective, we record increases in revenues with credits. And on the rare occasions we might have decreases in expenses, we would decrease those expenses with credits as well. And credit, again, simply means left-hand side of a T account. And if our revenues exceed expenses, we will have a profit or an increase in our net income or earnings. On the other hand, we record debits on the left-hand side of a T account, and debits are how we record expenses. And if we ever wanted to reduce revenues, we would debit revenues. And if our expenses are greater than our revenues, of course, we would end up with a loss. So there it is in summary. Let's look at our extended accounting equation. And by extended accounting equation, I mean simply balance sheet as well as the income statement and the relationship between those two. Again, the natural balance of assets is a debit, and the natural balance of expenses is a debit. And of course, those expenses are what would reduce our net income or generate a loss. Credits, on the other hand, the natural balance of our liabilities and equity accounts are credits, as well as increases in revenues. And think about that. If we have an increase in revenues, we're going to have an increase in net income or profit or earnings. And we can think about that link then between our income statement and our balance sheet. If we have a profit, in other words, our revenues are greater than expenses and we have earnings, that ultimately will increase retained earnings or stockholders' equity. On the other hand, if we had expenses in excess of revenues, we'll have a loss, negative earnings, and of course losses would reduce retained earnings. So that's our link between our income statement and our balance sheet. Let's go ahead now and walk through some income statement transactions. All right, let's go ahead and analyze the impact of some events on our income statement, and we'll indicate with a journal entry whether there's a transaction or no transaction. A, we provide website design services for $40,000. So we've provided a service and we'll have a revenue, and we are receiving cash. So we've got an increase in cash, and we're going to have an increase in stockholders' equity, which is our revenue. And in terms of our basic accounting equation, we increase assets, cash, with debits. And of course, debits have to equal credits, and we increase revenues with credits. All right, B, we provide website design for Acme Service Company for $20,000 on account. Now, notice the difference in wording. In B, we say on account. That means we're going to have an accounts receivable. When we're told that we're just providing services for $40,000, that implication is that we're receiving cash at the time of transaction. So the wording on account will mean the cash isn't happening right now. We've got an accounts receivable. Of course, if we were buying something on account, it would be accounts payable. So again, we've provided website design services. So once again, we've provided a service and we have a revenue. We have an increase in our stockholders' equity. And recording that with our journal entries, we have an increase in assets. So we will debit accounts receivable for $20,000. Debits have to equal credits. And our credit will be to revenues. Item C, we're collecting from Acme on account. So again, that account is referring to accounts receivable or accounts payable. And since we're collecting from our customer, we know it has to do with accounts receivable. So we're getting $18,000 in cash. We'll have an increase in one asset, cash, and we'll have a decrease in another asset, which will be our accounts receivable. And in terms of our journal entries, we increase assets, cash, with debits. Debits have to equal credits. And we decrease accounts receivable with a credit. So we've taken care of those first three transactions. Let's take a look at transaction D. We sell a $1,000 gift certificate. So we've simply sold a gift certificate. We haven't provided a service, so we don't have a revenue. We have a liability, and that liability is going to be referred to as an unearned revenue. But we've gotten $1,000 in cash, and we have that liability, unearned revenue. We're going to increase our asset cash with a $1,000 debit, and we increase liabilities, unearned revenue, with a credit of $1,000. Item E, the customer redeems the $1,000 gift certificate. Now that they've redeemed the $1,000 certificate, we have actually provided a service. So we no longer have a liability. Our liability will go down, and we have provided a service, and we've got revenue. And of course, our revenues will increase net income, which will eventually increase retained earnings, which is a component of stockholders' equity. In terms of our journal entries, we're going to reduce liabilities with a debit to unearned revenue for $1,000, and we record revenues with credits of $1,000. And again, debits equal credits. Item F, we've paid employees $16,000 for work that they've provided. We've paid them cash. So our cash is decreasing. They've provided us a service. So we're going to have a decrease in stockholders' equity. We're going to record an expense. And again, expenses decrease net income, which will, of course, reduce retained earnings eventually. All right, we had a recorded an expense. We record expenses, in this case, wage expense of $16,000. Expenses are recorded with debits. Debits have to equal credits. And that's good because we had a decrease in an asset, cash, and we record decreases in assets with credits. All right, item G, we're paying for $3,000 of insurance in advance for next year. Again, we are paying, so we're going to have a decrease in cash, and we're having an increase in an asset called prepaid insurance. Remember our matching principle. We're paying for insurance in advance for next year. So this will provide a future economic benefit. It's an asset. We're going to later on, of course, match that asset with the revenues it's generated. But for right now, we record it as an asset, we capitalize it. We increase prepaid insurance with a $3,000 debit, and we decrease the asset cash with a $3,000 credit. And let's go ahead and take a look at our last three transactions. In H, we have paid $9,000 in rent for the next 6 months in advance. So again, this will provide a future economic benefit. We have an asset called prepaid rent, and our cash went down as well. So again, our balance sheet equation balances. We have a debit to prepaid rent for $9,000 and a credit to cash for $9,000. Item I, we received a $250 telephone bill for previous month to be paid next month. So they already provided us the service. We have incurred a cost. So we're going to record an expense, and we're not going to pay it until next month. So we're going to have an accounts payable as well. So we will increase accounts payable, a liability, and we record an expense, telephone expense. So we record the expense with a debit to telephone expense for $250 and a credit to accounts payable for $250 to increase our liabilities. In J, we received a $500 utility bill for this month, and we're paying it immediately. So we've already incurred the cost, and the utilities have been used to generate current revenues. So we're going to have an expense, and we're paying it immediately. So we will have a decrease in cash. So cash goes down, assets go down, equity goes down, our balance sheet will stay in balance, and we're going to record utility expense in the amount of $500, and we're going to record a decrease in assets with a credit to cash for $500.